Let's bring in Jason Ware, Chief Investment Officer and Chief Economist with Albion Financial Group, and Chris Zaccarelli. He's Chief Investment Officer with the Independent Investor Alliance. Chris, I want to turn to you first, if I might, and get you to tease out a thought that I see in my notes. You say that as a strategic investor, it makes sense to invest in healthcare and technology and avoid utilities and consumer staples. But as a tactical investor, it makes sense to buy utilities and consumer staples and avoid the others. Explain to me the apparent disconnect, though I know there really isn't one.
Sure. What I'm trying to point out is that you're seeing a lot of investors move into those more defensive sectors like consumer staples, like utilities, trying to get out of the way of the big sell-off in those cyclical sectors like technology, like consumer discretionary. I think making a move into consumer staples and utilities would make sense if we're going to have a recession in the near term, but I don't believe we are, and that's why I'm saying exactly the opposite. Although in the short run, consumer staples and utilities look like a safe place to hide, I think over the next 1 to 3 years, you're going to wish that you hadn't been there because I think rates will go higher. I think the economy continues to do well. A lot of signs are pointing towards expansion, whether you're looking at 3.5% GDP growth last quarter, GDP now for this quarter is around 2.9% growth. Corporate profit growth is 24.9% in this quarter, year over year, and revenue growth is 19%. So yes, earnings are slowing down a little bit in terms of the earnings growth, but earnings are continuing. The economy is still strong. So for that reason, I think we have a ways to go before the next recession.
Chris, you say that the two big negative factors facing the market are the trade war with China and rising interest rates, the Fed. And you see the odds of trade war relief at a low 30% anytime soon, and the odds of the Fed indicating a pause in the interest rate hikes at 10% in the near term. So how do stocks keep moving up if those two big negatives are still in place for weeks and maybe months to come?
Well, I think when you look at the Fed, they've definitely communicated that they're going to continue to keep raising interest rates. They might take a pause in the middle of next year. So in the short run, I think if you're looking for the Fed to give you some relief by indicating that they're going to pause, I don't think that's going to happen. And I think, that, like I said, the odds are probably less than 10%. Your big hopes in terms of those two fears are some type of thawing or some type of relief in terms of the concerns around the trade war with China. The idea that we're going to have a trade deal with China by the end of the year, I think is not likely. And I think people are hoping that there's going to be a big breakthrough coming on the heels of President Xi and President Trump meeting in Buenos Aires at the end of this month. And it's possible that there's going to be some positive language in that direction. But again, I think there's a lot of hope placed in that fact. So really, I think if you're looking for those two fears, it's going to be some type of thaw, some type of announcement that the trade war with China is moving towards a resolution rather than the actual resolution itself. That's your big hope if you want stocks to move up in the short run. So
it's really, it's like the advisories that companies give. It's not what they do, but what they say in the forward guidance. Thank you, Jason of Albion Financial, and Chris Zaccarelli of the Independent Advisor Alliance.